Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 312 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including a NASDAQ 100 pattern, an update on the 4-year election cycle, copper tariffs, an update on data center usage, updated buy now, pay later data, and some strong earnings reactions. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you, so let's jump right in.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
Good morning, Nick. How are you doing this morning?
Doing pretty good. It's early August, so fantasy football is starting to percolate in the back of my mind. Seeing some early year rankings in the fantasy football world. So that's pretty much what's going on with me.
Yeah, we were just talking about that before we got started here. But yeah, oddly, the weather's cooled down a bit here, at least in Dayton, and we're in August, so it should theoretically be the hottest time of the year. But it's actually been quite nice since it's been ungodly hot for the past, seems like 2 months. So. But anyways, I digress, and we will jump right into the pricing. So this data is from Y-Charts, and as of the market close on August 4th. S&P 500 index is down 0.1% so far for the month of August, but up 7.6% for the year. The Dow Jones Industrial Average up 0.1% for the month and up 3.8% for the year. The NASDAQ Composite Index down 0.3% for the month and up 9% for the year. The Russell 2000 Small Cap Index up 0.2% for the month and down 0.6% for the year. And the Vanguard All World ex-United States ETF up 0.9% for the month and up 17% for the year. 3-month Treasury rate at 4.35%, the 2-year Treasury rate at 3.69%, and the 10-year Treasury rate sitting at 4.22%. Big headlines, current events from the week, Nick. More tariff news, which shouldn't be a surprise to anyone this year. President Trump signed an executive order on July 31st that increased reciprocal tariffs on several countries that are set to go into effect later this week, which somewhat surprised markets after there were constructive trade talk headlines over the past month and really the past week. July jobs report last Friday came in weaker than expected, with the economy not adding as many jobs as analysts estimated, and the unemployment rate also slightly ticked up. And finally, AWS stands for Amazon Web Services numbers were reported on Thursday evening when Amazon reported earnings, and the numbers were below expectations and contributed to the tech sell-off that we saw on Friday last week, Nick. So, we did get some weakness in the markets shortly after the market was just at an all-time high, but there was kind of a combination of things that contributed to the market weakness on Friday, which leads me right into my first point, which was a post on X from Jason Goepfert on July 31st. He said, here's every time QQQ, which is the NASDAQ 100 ETF, gapped up greater than 1% to a new high and then faded. The next week, throw up face emoji, and then 2 to 3 weeks out is the halo emoji. So essentially, if you're not watching this on YouTube, what this chart is showing is the QQQs gapping up to a new all-time high by more than 1%, but then closing negative on the day. So a strong open and then fades into the close. And what you're going to see is a week later, stocks are only positive 25% of the time. But if you look out 3 weeks later, stocks are positive almost 90% of the time. So I think this goes with the theme that we started talking about a little bit last week, Nick, in that August and September tend to be a pretty poor period of time for stocks. So, obviously we would have loved to see, Amazon and other names react differently on Friday after they reported. But like we discussed last week, a breather wouldn't be the worst thing in the world right now.
Yeah, seeing some consolidation in the market is never a bad thing when we've been on such a historic run. I think, as we've talked about many times in the past, that's just a sign of healthy markets. So.
Yeah, I would agree. Next was a post on X from Nautilus Research on July 7th with an update on the 4-year election cycle for the S&P 500. So they said 2025 versus 4-year election cycle composite. So the 2025 S&P 500 performance is the red line. The black line is the average seasonal composite for the 4-year election cycle. And what it shows, Nick, is that so far, starting in 2024 with the election year, markets have tracked pretty closely to the average. And when we look at charts like this, I always like to say, I'm not comparing the percentage moves up or down, but more or less the trend of the move. So election years tend to be relatively strong. 2024 was a good year for stocks. And then the beginning of post-election years, 2025, tend to be weak. We got that weakness. But then markets start to turn around in Q2, Q3 of a post-election year. That's exactly what has happened so far. And then if you're looking at this chart, Nick, you'll see that, there does tend to be some weakness here in the middle to end of summer to the beginning to the middle of the fall before things rally a little bit in Q4 towards the end of the year. So, so far, I think this has been a relatively average post-election year minus the, almost bear market that we went into in the beginning of April. So,
yeah, I think for anyone watching this on YouTube, a reminder that black line is a line of averages. So it's going to, by data definition, is going to be smoothed out a little bit, which is why you would expect the red line really in any year, not even just this year, of course this year, but any year that you're looking at it, you would expect to see it a bit more volatile. Yeah, a bit more volatile, right?
Right. Yeah. Right. So, so again, it's that black line, as Nick said, is just an average. So we can expect there to be years where markets are stronger and years where the market is weaker. So, last thing I have, Nick, before turning it over to you, was a post on X from Renaissance Macro Research. This was back on July 30th. So a few weeks ago, before I get into this post, President Trump announced additional tariffs on copper. And then shortly after that, he walked back that statement, and copper had one of its worst days ever, falling almost 20%. I think it was around 18% it fell on the day. And then if you bring up this chart of what Renaissance Macro Research posted, they said, if you know, why we don't chase news-driven breakouts. And as you can see, a few days before copper absolutely fell on its face, there was a huge breakout to new all-time highs, which is that kind of that clear big candle there, Nick. And I'm not necessarily even trying to make a point about copper specifically in tariffs, but the point of chasing news-driven breakouts is a good one. An example of this that we've seen in the past is regulation on Bitcoin, whether that's positive or negative. We've seen breakouts or breakdowns on if it was positive news or negative news, and more often than not, a couple days, a couple weeks, a couple months later, the move was invalidated. So I think you get people that get really excited for a certain period of time over a certain subject, and they drive the price up or they drive the price down of something. But then once the market actually digests the news, a lot of the times they're like, oh, it's not as good as we initially thought, or, oh, it's not as good as, or excuse me, not as bad as we initially thought. So that's why it's just good to, not place trades in your investment accounts when you hear some news headlines come out, because a lot of times, the first move is the wrong move and it actually goes in the other direction eventually.
Absolutely. I think another good way that listeners at home can think about this is think about how big Wall Street is, how many years the street has been doing this, how powerful these institutions are, high frequency trading, momentum money. There's a lot of money out there, a lot of really smart people, a lot of really smart companies who have been doing this for hundreds of years. When you're reading the news, when you, especially mainstream news, something from CNBC, headline kind of news, when you're reading that, you should think that it's already priced into the stock. By the time you're reading and consuming that, it's priced into the stock is a good way to think about that generally. And maybe you read something about a specific sector or individual company that you like. If you like that company, fine, go buy it. But you should be buying when you're sitting at home. For your average listener, you should be buying for the long term, because again, that the news headlines, you're talking about it right now. You're showing it on a chart. This is what can happen to you.
They're gotcha events.
Yeah.
You generate a lot of excitement, and yes, there are people out there that kind of prey off of that of people, and there's market makers and other participants in the market that drive that price up, knowingly that they're going to do it to pull the rug out from most retail investors afterwards. So, just a gentle reminder that I wanted to share. So, with that being said, Nick, let's talk about data centers.
Yes, my first piece here is on data center energy usage. It's an ex post from Zero Hedge, which says that data centers will represent between 6.7% on the low end and 12% on the high end of all U.S. energy usage by 2028. A difference of 255 terawatt hours of energy, equivalent to the energy consumption of over 24 million households. And this research is coming from the Lawrence Berkeley National Laboratory. And there's a chart here that just shows you those numbers and where we are today. And where we are today is at 4.4%. So that could triple, is what they're saying on the high end of that. And on the low end of that, it's going to increase a couple of percent just within the next 3 years, which is notable. And a reminder for anyone who's not familiar with data centers and their purpose, in a nutshell, a data center are these massive facilities that are being built that literally hold servers and hold data. And when you think of the cloud, it's not just up there in the cloud. It's in a data center. It's just easily accessible from that data center because of the internet.
Right. Yeah. Thank you for clarifying that, because I think there's a lot of people, at least that I've talked to, they're like, okay, I get it, like data centers, but like, what are we really talking about
what's
here?
What's the deal? Yeah.
So yeah, it's a good point. And, energy's been a problem, or it's seemingly been a problem for like the past 100 years, where there's been questions about how we're going to power this stuff. And lo and behold, every single time we figure it out,
come up with something.
Right? So it's kind of the old Warren Buffett adage is never bet against the American economy and American excellence. So
I had an econ professor who said that. In one of his lectures, someone asked a pretty good question. I forget exactly what the topic was about, but it was something along those lines of, like, let's take data centers, for example. It's like, okay, well, what happens when the data centers get so big and we literally don't have enough, or we've run out of our reserves and we don't have enough oil, or in a hypothetical scenario. And his point was that never bet against human innovation. And we've been innovating for years and years and years. And if you're forecasting that out for however many years, he says, by the time you'll get there, we will probably have innovated to fix one of the solutions.
Yeah.
I thought that was pretty insightful, because there's lots of times in history where that does hold true.
Yeah,
So.
I mean, it's like every technological innovation, it seems like, like AI, they think that they're going to take everybody's jobs, and sure, they might take some jobs and make people more efficient, but it was like the thing with like the horse and buggy back in the day that eventually got to like a car, and then we got to an airplane, and it's like, it just made things more efficient and allowed people to go work and do other types of things. And I think it's no different this time, but if I were a betting man, I would say we're going to be able to figure that problem out.
Yep, absolutely. So my next piece is about buy now and pay later. Missed payments are rising. And this is from the Kobeissi letter. It's an X post. Apologies.
Which, FYI, can be fear-mongery at time.
Yeah, for sure. Yeah. This is the buy now, pay later market. It's not really massive. I mean, I know these numbers sound massive, 120 billion, but in the grand scheme of the economy, these are pretty. These are
what
pretty
Nick's
small.
talking about is if you like if you order something online and like the checkout is like from like Shopify, where you can do like the Shop Pay or like Google Checkout. A lot of times when you buy stuff now, you can say, hey, pay over 4 months or pay over 8 months or something like that. So it's just what it is. You buy it now, but you're paying over a period of time. And, I've even seen this with like, ordering, like food, like grocery delivery service,
groceries,
flights. I've seen it with, just like little things on Amazon for the house, which is
that's
interesting.
a firm, right? That's that company.
A firm. Yeah. Correct.
So the post says that annual buy now, pay later transaction volume is expected to reach a record of 116 billion in 2025. That will be double the 2022 total and 7 times higher than the 2020 number. Buy now, pay later use is exploding as consumers are increasingly searching ways to borrow for spending. A Lending Tree survey shows that 25% of users now rely on buy now, pay later to buy groceries, up sharply from 14% last year. Meanwhile, almost 25% of buy now, pay later users missed at least one payment in 2025, up from 15% in 2021, according to the Fed data. So it's just a sign that there's a section of the economy, which we've talked about recently, that is under more stress.
Can you read that last line that they had in this post?
The Americans are piling on debt like never before.
Mm-hmm. See, so
I kind of skipped that because I don't know.
I knew you did, but so I wanted to make a point on this. So missed payments on stuff is never a good thing, right? Mm-hmm. But when we're talking about something like this, I think it's one of those situations where we need more context, kind of like, people defaulting on car payments or missing credit card payments. This is something similar, because if 20% of that 25% of buy now, pay later users missed at least one payment in 2025, we need to know how much those payments were.
Right.
Because if 20% of them were $30,
right,
and they just forgot to make the payment, that's a way different conversation than if it's a couple $1,000 payments, right? So I think this is one of these, gotcha headlines that try to spook fear into people, unfortunately. And like I said earlier, the Kobeissi letter is known for doing this. I'm not saying they don't have good content from time to time, but this is something that I think is, if you don't dig into the weeds on it, you could get spooked for no reason.
Yeah, absolutely. That's one of the reasons why I preface this as this is not a big section, because again, 125 billion of the U.S. economy is not massive compared to, like you mentioned, credit card delinquencies and car payments. Those I'm guessing, I've not looked at the numbers, but those have to be 10, 15, 20 times the volumes of the charts that we're looking at here.
100%.
So interesting, but I know the past couple of weeks we've talked about how different sections of the economy, consumers are under pressure. We obviously know that the lower income consumers of America are under pressure just with inflation and grocery prices. So this is really just a data point that kind of helps confirm what we assume and what we know from that perspective. But like you said, nothing to panic about from a market investing perspective. So the last piece I have here is about strong earnings reactions. And I know you and I actually talked about this the other day, just briefly. This is from Mike Zaccardi, and he's quoting research from Bank of America. He said, Bank of America on Q2 earnings reactions mentioned that healthy rewards are being seen for beats and the misses are getting crushed. Companies that missed on both EPS and revenue are getting crushed, is what he says here, lagging on an average by 8 points. So what we're seeing is that in this earnings environment, let's say a company typically beats, and over the past, like, let's say 6 quarters, the move on their beat is they go up 1 or 2%. What we're seeing this quarter is it's about 3 times more. So that company that historically their earnings moves the stock maybe 2% up, 2% down, it's more like 6% up and 6% down. And that's what Bank of America is saying here. And that's, you and I have just noticed that just looking at the market, and like, wow, we're really seeing some outsized moves, both on the upside and on the downside, which is interesting. And I know I talked about this a couple weeks ago, where thus far we're not seeing anything that's on the whole just absolutely move the market lower from a overall corporate earnings perspective. The health of the corporate economy is still there. Obviously, there are misses and beats always, but it is interesting to see that the reactions are notably a bit more volatile. So I don't know, what are your thoughts on all that?
Yeah, I think it's, like you said, just with me and you kind of doing the eye test of tracking this stuff by looking online after people have reported. The moves have definitely been more outsized, and I couldn't tell you why. I mean, just up until last Friday, volatility was pretty low in the 13 to 16 range before we got the spike on Friday. So I don't know. I don't know if it's people getting back from summer breaks and into the office and reallocating portfolios based on what's happening with earnings, but it definitely is noticeable that the moves are larger. People are getting rewarded if they have a good quarter, and people are getting punished quite significantly. Stocks, that is, if they have a bad quarter. So interesting nonetheless. We've had surely had our bouts of volatility this year, and this is just adding on top of that. So we still have a couple more weeks of earnings season to get through. Last week and this week are the big ones. So after this, the news on it should die down a little bit. And most of the, I don't want to say most important companies in the world, but the biggest companies in the world,
the market cap
and
leaders,
really most important, I guess, from a stock market standpoint, will have reported by the end of this week. So
the big one that will be later, and they'll be in, I think, a couple weeks, will be NVIDIA. They always report very late.
They do. Yep. Well, Nick, I think we're going to go ahead and leave it there for this week. Anything else before we sign off?
No, just a reminder that any names we talked about in the podcast today are not a recommendation for or against those names. We're merely commentating on the markets.
Right.
So.
All right. Well, thanks everyone for listening to episode 312 of the Independent Advisors podcast. We will be back with you next week for episode 313.
Thank you for listening to the Independent Advisors podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.